In our previous videos, we talked about the value of Bitcoin at the national level. And now, with prices surging so sharply, holders are grinning from ear to ear. But have you thought about this? The faster it rises, the bigger the risks behind it might be. There are problems nobody's talking about right now. But if they erupt, they could shake the very foundation of confidence in Bitcoin and turn into a disaster. Today, we'll break it all down. We'll start with concentrated holdings, move on to minor revenue issues, and end with the 51% confidence crisis. Step by step, we'll unpack how this entire vicious cycle could form. Let's begin with so-called Bitcoin reserve companies. The most famous is MicroStrategy. Its core business is enterprise software, but a few years ago it began borrowing money just to buy Bitcoin. By issuing bonds and taking loans, they converted their funds entirely into Bitcoin, locking it up long-term without selling. Now, Bitcoin makes up an ever larger share of their balance sheet. What's unique about this? When Bitcoin rises, their debt stays the same, but shareholders' equity is magnified. So MicroStrategy's stock became a leveraged Bitcoin play. Over the past year, Bitcoin rose about 150%, while MicroStrategy's stock soared nearly 300%. But leverage cuts both ways. When Bitcoin dropped 20% earlier this year, MSTR plunged over 30% in a single day. These companies amplify Bitcoin's volatility, adding yet another layer of risk. Now combine these reserve companies with ETFs. Together, they're locking up huge amounts of Bitcoin, shrinking market liquidity. By mid-2025, US spot Bitcoin ETFs held nearly 6% of global supply, over 1.2 million Bitcoins in just months. Meanwhile, MicroStrategy alone holds over 200,000 BTC, almost 1% of all supply. And then there's nation-level buying, El Salvador using Bitcoin as reserves, and even rumors of Middle Eastern funds entering. These long-term holdings keep draining the floating supply. When circulation tightens, any spike in demand pushes prices even higher. To understand this, think back to GameStop in 2021. Retail traders rallied online, hold the line, don't sell. Meanwhile, shorts were forced to buy back stock, fueling the squeeze. In months, GameStop shot from tens of dollars to over $400. Bitcoin is similar, but not the same. Yes, supply is concentrated. ETFs, corporations, even nations hoard it. But unlike GameStop, this isn't hype. It's structural, it's ongoing, and it means Bitcoin's price will keep getting more sensitive to demand. But when everyone's holding tight, another problem emerges. Ask yourself this: if Bitcoin rises 5% today and 10% tomorrow, who's still going to spend it? The answer: fewer and fewer people. Bitcoin's use as a transactional currency weakens. It becomes just a reserve asset. But declining transactions hit more than payments. They directly affect miners. Block rewards halve every 4 years. By 2024, they were down to 3.125 BTC per block, and they'll keep shrinking. Eventually, miners must rely on transaction fees. And right now, since early 2025, daily transactions have hovered at 320K to 500K, down nearly 50% from 2023-2024 levels, when they often exceeded 700K a day. If miners can't earn, they quit. Hash rate falls, and network security weakens, threatening Bitcoin's core foundation. This triggers a clear chain reaction: locked supply, price up, less spending, transactions fall, miner revenue drops, miners quit, hash rate declines, security weakens, and when small miners exit, hash rate concentrates in just a few big pools or corporations. This centralization raises technical risks. Because once hash rate is concentrated enough, a 51% attack is no longer just theory, it's possible. A 51% attack means one entity controls over half the hash rate, reorganizes transactions, and performs double spending. Even if no coins are created out of thin air, the trust in Bitcoin would shatter. And even without an actual attack, just headlines like "two entities control 50% of hash rate" could spark panic selling. Bitcoin's value is built on the belief that no one controls it. If that belief cracks, confidence collapses, price drops, hash rate falls further, and the vicious cycle feeds itself. And that's just one category of risk. Bitcoin also faces policy risk, tighter regulation, higher taxes, or even circulation limits from major countries. And technology risk, Faster, more secure payment chains, or even superior cryptocurrencies, could eventually erode Bitcoin's demand. Bitcoin's fixed supply drives prices higher, but it also stacks risk upon risk: concentrated holdings, falling transactions, weaker miner revenue, declining hash rate, plus policy and tech threats. These aren't short-term problems, they'll surface over time. So here's the question: does Bitcoin carry hidden risks? And when might they explode? Drop your thoughts in the comments.